Fed Kashkari Shocks rate cut expectations by saying the next move could still be a hike or a cut. That two-way warning matters because crypto and other risk assets were not built for a single policy assumption. Kashkari's message is that the Federal Reserve has to stay flexible and react to inflation, employment, and consumer spending data. The market tension is simple. Sticky inflation argues for restraint, while weaker growth would make lower rates easier to justify. The immediate pressure is that markets now have to price a wider policy range. The reason this deserves attention is that rate assumptions shape dollar liquidity for risk assets. Read the event through this lens. Kashkari kept both a hike and a cut on the table. The confirmed baseline is mixed economic data and a central bank unwilling to lock itself into one path. Inflation has cooled from its peak, but remains above the Fed's 2% target. The labor market remains strong, while consumer spending has shown signs of slowing. That combination makes the policy path unusually wide because each new report can support a different argument. Those facts put inflation is still above the 2% target. Beside consumer spending has shown slowing signs. That baseline keeps the segment grounded before the mechanism takes over. The factual floor is inflation, jobs, and spending point in different directions. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The mechanism is liquidity pricing. Higher rates usually support the dollar and yields, while lower rates can make speculative assets more attractive by reducing the cost of money. In plain English, crypto traders are not just watching the Fed meeting, they are watching the data that changes the meeting's options. Fed Kashkari Shocks matters here because a market priced for cuts can reprice quickly if inflation refuses to cool. The operating detail is that higher rates can pressure speculative assets, while lower rates can help liquidity but may signal weakness. That is the part viewers need before judging the headline. The mechanism stays concrete because policy expectations move through yields, dollars, and liquidity. The affected side is anyone exposed to dollar liquidity: crypto traders, bond investors, stock buyers, borrowers, and savers. A hike would tighten financial conditions, while a cut would ease borrowing costs but could arrive only if growth weakens enough. That means both outcomes carry risk. Easier policy may help liquidity, but the reason for easier policy could be economic stress. Crypto still has its own drivers, including regulation and institutional flows, but rate expectations remain a major macro layer. The practical effect lands on crypto and risk markets because borrowers would feel a hike through higher costs. The secondary read is that savers would earn less if cuts arrive. The effect is not abstract. Crypto and risk markets face both tightening risk and slowdown risk. The unresolved part is which data point forces the Fed's hand. Kashkari's comments do not set a decision, they define the range of decisions that remain possible. A sustained drop in core inflation would support cuts, while strong hiring and stubborn prices could keep hike risk alive. The statement should not be read as a promise that either move is imminent. The clean split is that the policy range is open, while next data sequence still needs evidence. The unsupported leap would be this: no rate decision has been locked in. The clarification needed is PCE, jobs, and spending data will guide the path. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The next signal is core inflation, monthly jobs data, and consumer spending. For Fed Kashkari Shocks, those reports will decide whether traders lean toward relief, renewed tightening, or a longer pause. The crypto readout is not a guaranteed price direction. It is a liquidity map that changes as the data lands. The key is that the Fed path has become two-sided again, and risk markets have to price both sides. The decisive test is watch PCE before rate bets harden. That matters because fresh data narrows the Fed path. The next stage should be judged by core inflation and jobs data, not by guesses.